The beauty of live television is that you never know what you're going to get or not get. So we thought we were going to have Domenico Dalla Olio today to discuss some things ahead of NVIDIA earnings, but unfortunately there were some miscommunications and he won't be able to join us. But we're going to take a look at NVIDIA earnings anyway, because that's the most important one of the quarter. We might as well take a look today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to what would normally be office hours with Professor Mark Guthner at this hour, but Mark Guthner is actually attending a commencement today, so he's not going to be able to join us, and we were going to have Domenico Dalla Olio in his place, but unfortunately, due to a miscommunication, he wasn't able to join us either. That said, NVIDIA earnings is not going to go away simply because they couldn't make it, so I figured I would just take a look at a couple of things with you, which you may find interesting, because I certainly did. Let's look first at what some of the flows are doing in there today. So I'm just going to pull up the trade alert just so we can see what kind of big prints we were getting. And let's see here. I'm going to pull that up. Give me a second. All right. So here, I'm going to do this. Actually, I also have to make sure I pause this because otherwise this is going to just start putting all the big prints by. So one of the trades we can see here, and actually this could, I better double check that, but we are on the 19th. That's almost certainly not us. But what we are seeing in NVIDIA at the moment, ahead of the print, is slightly below average call volume. Right now, we're expecting to get about 3 million contracts. And if you remember, when I was looking at this yesterday, let's do this. I'm going to just go back to yesterday's flow for the full day. And we can see what the sentiment was. We can see that a little bit more of yesterday's sentiment was bearish relative to bullish. Now, the reason I'm bringing this up is because as I started to review the volatility surface for NVIDIA between yesterday and today, I noticed something interesting that was not entirely consistent with this. So another quick point for those who did not see yesterday's video, I want you to pay attention to this number right here. So this is essentially how many share deltas the options market was a net, in this case, seller of. You can see that's a negative number yesterday. So effectively, between call purchases and sales, put purchases and sales, the net delta of the initiating flow in the options market yesterday was shorter by 4.7 million shares. So 4.7, we'll call it $222 a share. That gets us to just over $1 billion net shorter. $1 billion in NVIDIA. In any other stock, that's probably quite a lot for the market to reduce its exposure. In a multi-trillion-dollar company like NVIDIA, not so much. For what it's worth, I happened to mention this yesterday. We have significant exposure via swaps, the common and options positions to NVIDIA, probably on the high side of about 1.6 billion net long right now, and that's only within the YieldMax ETFs. So if we broaden that out to look at title more broadly, it's probably closer to 3 billion net long. Not uncommon, by the way, for most money managers to have significant exposure to the largest company. It is, after all, the largest constituent of the S&P. It is the largest constituent of the NASDAQ. But what I found interesting, and let's just I'm going to look at today's as well. We're going to look at the sentiment. So here's the sentiment today. A little bit more mixed. Stock is higher, as we can see, up small, and looks like it's about evenly mixed in terms of sentiment. But this isn't the only way we look at sentiment. It's not the only way we should look at sentiment. Another way to look at sentiment is to take a look at the volatility surface. And what we're really looking for here is a couple of things. One, we're trying to see how big the event variance is. The event variance we can see by looking at something looking at the term structure. So I'm going to get rid of this. This basically is the options that are going to be expiring immediately following the print, and then as we go further out in time, we can see these longer dated options. So there's a decent bit of event variance in there, but is it really unusual? To take a look at that, what we can do is say, okay, well, what's the average move for the stock when they report? That turns out to be, over the course of the last decade or so, about 7%. And what's the one-day implied move? Now, the one-day implied move, I tend not to focus as much time and attention on this because the one-day implied move is derived by taking neighboring implied volatilities, and if the entire surface is slightly higher than it otherwise would be, that can distort that calculation a little bit. So what I prefer to do is just estimate what the mean absolute deviation is for the given expiration week and compare that to like periods in the past. So to do that, I'm just going to put in a little bit of a custom here. I'm going to go, I've got something flying right here, sorry about that. So minus 1 day to positive 2 days, and that bumps it up to about 8.14%. So now I have a number that I can compare to the straddle that expires at the end of the week, because now it's kind of like for like. So I'm going to do that. And as we take a look at the week ending straddle, so we're at 222.5. And we've got 720 and 680, let's just call it. So $14. $14 over 222.5, or 223, why don't we say, is about 6.3%. So the options market, at least as far as this is concerned, is implying a slightly smaller move than usual. Okay, so that's the first thing we can think about. How much is the options market actually expecting the stock could move higher or lower without any fear or favor with respect to direction? So is the market expecting it to go higher or lower? The next thing we can look at is what we were taking a look at before, which is how much call buying was there, how much call selling was there, how much put buying, how much put selling. Those also can give us a gauge of sentiment. But another view of sentiment comes from the vol surface itself, and there we can take a look at something called skew. Skew describes the relationship in options pricing terms, described in implied volatility, of the upside calls to the at-the-money options to the downside puts. Now, this is going out 3 months. We're not really interested in that. We are interested in the options that expire at the end of the week. This is not granular enough for us, so what we're going to do is we're going to just put this in as strikes. And now look what emerges. So the stock's trading, as we know, right around here, 222 or so, and we can see that there is a pronounced call skew in here. Now, if you've never looked at a skew chart before, this may not be of much interest to you, and you'll say, so what? So the left side's lower than the right side. Does that mean anything? Well, in equity land, that's actually somewhat uncommon. And actually, if we compare it to the Qs, I'm going to put the Qs in here for the exact same period. And now we're going to have to look at it a little different way because, of course, the strikes don't line up dollar for dollar. So I'm going to look at this. We could look at it in moneyness terms, for example. So if we're looking at it in moneyness terms, this right here, this section is the at-the-money strikes. So we can see that the calls are trading at a premium in NVIDIA. They are trading at a discount in the Qs. And the puts are trading at a discount in NVIDIA. And it's trading at a premium in the Qs. And the reason that struck me as very interesting was because NVIDIA is the largest constituent of the Qs. So I found it very interesting. You can see here NVIDIA is 9%. 9% of the Qs. And if we look at SPY, we're going to get also another 8.5% right there. So I found that to be very interesting, that there is a pronounced call skew for NVIDIA going into the print relative to the cap-weighted major indices of which it is the largest constituent stock. So one might assume that some of the options trading activity that's going on in these cap-weighted indices and their ETF proxies is also directly related to expected outcomes as a function of NVIDIA's results, which is to say, if NVIDIA once again comes out with a stellar number, blows the doors off of earnings, one would expect that would be generally good for equities in general, whether it's the SPY or whether it's the Qs or anything like that. So I think it also makes some sense for us to take a quick peek and see what the sentiment looks like in those as well. So we'll do that very quickly too. And actually, you know, it's interesting because we can check the sentiment in the options markets overall. So the Qs sentiment slightly bullish. Notice it's actually only 1% more bullish than bearish, which is exactly what NVIDIA was. And for SPY, we can do the same. And here it's spot on. And let's see if we can get, I want to see if I can get a time series chart for this, which might also be interesting. So let's see, I knew I had a sentiment chart in here. Let's see if I can find that one. Let's see if I can get that sentiment chart. Where is my sentiment? Do they still plot that over the time series? Let's see. I thought I was able to get a time series chart for that. I'm not seeing it anymore, but basically I could sort of gauge the relative bullishness and bearishness. But this does give us a sense of it at least. What you can see here in green is the calls, in red the puts. I'm going to go back again. And you can see, for example, that the sentiment in here a few days ago was decidedly bearish. So anyway, that's I think fairly interesting as well. Let me just also pull up my social media comment section. I don't know if anybody is here or not. See what else is going on. Okay. So bear with me one more second. This is, like I said, we're doing it live. I think it was Bill O'Reilly who said that before one of his shows, since we were going to do something very different today, but I don't mind mixing it up a little. Let's see if there's something else that's of particular note or interest, I think, that we should pull in today to take a look at. So here we have, let's see, this, by the way, so we do see that the VIX is a little bit higher. One thing I will mention, because I had totally forgotten about this, is that this is Memorial Day weekend. For some reason, it felt like mid-May. I hadn't really been thinking about it. And then I was reminded that, and partially because I'm traveling for business this weekend, it didn't occur to me that I would have had business travel on a weekend that was a long weekend, national holiday, and all of that. But it turns out I'm traveling both Saturday and Sunday for work. When you look at the VIX, it is important to recognize that the VIX is a 30-day forward look, but the amount of premium that's going to be in those options is really more associated with the number of trading days. It's not to say that a holiday or a day off or a weekend day doesn't count at all, because news can break, right? So they do count, but they don't count the same as an actual day where you can trade. So I would just point out that this 30-day period has one less trading day in it than you would normally anticipate. So a reading of, call it 18 in the VIX, is arguably a little bit higher than you would otherwise think. So you could make an adjustment, do a little bit of mental math and say, okay, well, the VIX is actually closing on the high side of 18, not the low side at this point. And that's, the way we think about the VIX, I think this is kind of an important thing too, is that the mean VIX, since they first initiated the calculation, so the calculation period actually predates the actual release of the VIX index itself. But the mean over the calculated period, I believe, is in the neighborhood of about 19.5. But the thing that's interesting about that is that you have to remember, and I think I've used this analogy in the past, that it is not, the median and the mean are not the same. And the reason that this is true, and I'm going to just draw this line that'll help illustrate the point, is that, and this line, by the way, is drawn, about where we are right now, is that these isolated events that take place, when you see big spikes in volatility, they disrupt the averages much more meaningfully. Kind of like I think the analogy I used in the past was Jeff Bezos or Bill Gates walk into a bar. The average net worth just went up sharply. I think this is a good way to think about it, that really what you have is sort of normal volatility regimes that are going to exist in and around, call it 15% annualized or so. And then you have these more elevated periods. We are in an elevated period because we're in the midst of a significant geopolitical disruption, and that being the Strait of Hormuz. Oh, this is also another important bit of news, if you guys didn't happen to see it, is that they're discussing it. I mean, I don't know what discussing actually means. We'll see. But NATO is discussing the possibility that they may act to try to do something to secure the strait if this persists into July. Now, whether or not they actually act or they continue to sit on the sidelines, it will be interesting. But of course, many other NATO countries besides the United States are even more dramatically affected by what is going on in the oil markets right now. And that is because most of these places are importing inflation rather than merely transferring it. What do I mean? If you consume oil in much greater quantities than you produce it, which is generally the case for most of Europe, then you are importing inflation. In the United States, we produce approximately as much oil energy as we consume. As I've previously mentioned, there's some nuance in there related to product, but in terms of millions of barrels of oil equivalent, we're producing about 21 million barrels of oil equivalent a day, which is actually slightly in excess of what our current use is. So that does not mean that consumers don't feel the pinch at the pump. They do. It does not mean that it's not going to affect discretionary spending in other areas. It probably will. But what it does mean is that rather than that higher price, all of those dollars flowing out of the country, for example, to Middle Eastern producers, it's essentially being transferred domestically. And of course, we have another really meaningful benefit, which is that one of the largest disruptions that has taken place in this area has been in natural gas. Natural gas being much harder to transfer. Take a look at this. This is natural gas in the United States. This is the Henry Hub contract, which is actually what I used to trade when I was on the New York Mercantile Exchange. But our prices are actually lower than they were in December. Not so in Europe. And this, by the way, continues to be, in my view, supportive of companies that depend on natural gas as a feedstock domestically, such as CF Industries. So CF Industries, fertilizer producer, North American exposure, therefore using North American feedstock, much, much lower cost relative to producers elsewhere. Huge, huge benefit in that area. Okay. As we just sort of take a look at what's going on in the options markets more broadly, figured we might as well take a quick peek at some of the names that are seeing some unusual activity today. TJX, seeing significant unusual volume. Why don't we take a quick peek at that? See what's going on. We'll just go through this one by one. So they have earnings before the open tomorrow. Sentiment is, bearish, huh? What's the biggest trade in here? So we've got sales Sales of the June 5th 155 calls. This was an intermarket sweep opening. So it looks like some individuals think that the potential upside here is not worth betting on. And let's see, the net option deltas today, 228,000, which would be peanuts in something like Nvidia, but we can compare that to the ADV, 35 million of net sales. Let's see what else we have. So, ServiceNow. Let's see what's going on there. That looks big. 380,000 contracts. What do we have here? Opening activity. Weekly 110 call sales. Let's take a look at that. See what's going on. Top trades and sweeps. So we got the 110s. Similar type of activity. Hitting bids. Let's see what else we have here. Depot post earnings. This is interesting. So they hit their 52-week low. It's actually trading slightly better than that now. And there we go. Okay. So it looks like we actually have some people coming in to buy the dip here. What's the biggest trade we've got in Depot? Sale of 2,400 of the July 260 puts at 282 opening. All right, that's an interesting one. Let's take a quick peek at how that might look. So first, actually, let's take a look at that first. So even before we do anything else, so the risk you are taking is that you own the stock at 260 by selling those puts. All right? And since that's the risk, your return on that, on basically the worst case, which is that you own the stock at 260, 282 over that, so that's more than 1% of the risk that you're facing. And those options expire. Let's see how many days that is exactly so we can do this math a little bit more precisely. Let's see, July is 59 days away. So basically, you are getting 6.7% annualized to take the risk that you might own the stock at around, just for round numbers purposes, but we'll call it 257.5, whatever. Let's see here. We're going 259, one spot 23. So you're getting paid about 6.7% and taking the risk that you own Home Depot at an 86% discount to the current price. And let's see the last time it actually traded down there. Let's go back in time. So what was this low? That's even lower than that. Okay. Let's go back 10 years then. So your risk is, if you sell those puts, that you're going to own the stock at 259-ish. So that's, yeah, okay. So actually get it back to 2021. But I'm going to put it in here too. So that's basically the level that you're talking about right there. Now, let's just quickly compare what the fundamentals look like now versus then. So for the full year, we're looking at 171 million in revenues. We'll compare that to what they were doing back in 2021, 22. Significant improvement. Let's call it the 21 numbers, 132. So you'd own it at the same price that you would in 21, but it's got 30% higher revenues and 11.2 billion in net income and 11 billion in free cash flow. And we're looking at 14,905 versus 11,200. 33% higher net income. And we'll just call it 15 over 12. And about, yeah, 27 to 30% higher free cash flow. I don't know. I think this one starts to look a little interesting. I would probably bump the strike up, though, a little bit. I'm not enamored of taking equity risk, I have to say, for less than what you would hope that equity would pay you for the risk you're taking on an annual basis. So where does that get us? I'm looking to trade a 45-day option for something that looks like at least 12% annualized. So 12% annualized, that means that for that 45-day option, which is, so we go like this, 365. So that's 8 spot 11, 12 divided by 8 spot 11. So I'm looking to get at least 1.5% for an option with that type of time frame. Let's see what we get. That's going to have to be, I guess we have to go out to July because the weeklies don't stack up that neatly. So maybe that's close enough. So rather than doing something like those 260s, and actually you can get more for those already. Look at that. So this is kind of interesting. Oops, let me clean this up a little. There we go. So these are the options they're selling. Looks like you could get about $2 a contract for those now. But what I would be looking to get would probably be, I might be looking more in this neighborhood up here, the 280s and 285s. These seem a little bit more interesting to me. You're willing to draw a line in the sand, 25, 30 delta options in that neighborhood. These 280s look kind of interesting. 5.25 over 280. Let's just say that you got them off there. 1.88%. We can get a little better than that. 285s, we'll call it 7. That's 2.5%. Yeah, so I think that one looks pretty interesting. That would be a decent way to play it, in my view. And I don't think you really need to buy some kind of a tail risk hedge in the downside put because we already have the catalyst. We already know what the story is. Let's just quickly see what the analysts have to say about this one. I'm being pinged by the investment team on the side here. Hang on one second. Just make sure I know what's going on. Okay. Oh, let me get the NVIDIA. Oh, Monday morning quarterback. Based on your NVIDIA SPY Q analysis, if you were bullish on NVIDIA, you buy SPY or Q? If so, suggest a trade. Yes. Okay, so here are two ways to take advantage of that skew dynamic, right? So one of the ways to do that is that normally, just imagine in your mind, let's just say that I wasn't talking about NVIDIA. I was just talking about a reasonable call spread to purchase at to just out of the money in a stock. What would I normally expect to pay as a percentage of the distance between the strikes? And since you can't answer me, I'm going to assume that you guys are saying to yourselves it's somewhere in the 30 to 40% range. Like if you think of a reasonable price, that's why we often like to sell call spreads, right? We sell call spreads because you get a fairly good percentage of the distance between the strikes in terms of premium. Selling put spreads, the math doesn't seem quite as exciting or interesting very often on a risk-reward basis because due to skew, a put spread might be trading for 20, 25% of the distance between the strikes. And I apologize because I'm also keeping my eye on my trading chat over here just in case there's something going on there. Okay, so let's pull up some charts here on NVIDIA and see how this actually looks. So, and we can use as a framework what the options market is actually anticipating. We already did that work, right? So 5.5%, 6% is what the options market is anticipating by the end of the week. So let's just say, for the sake of argument, that you said, okay, well, I want to buy an at-the-money call. So we'll make it the weekly 225s. And I'm going to sell something that's, call it, 5.5%, 6% out of the money. I don't know. So this is using 222.60. So why don't we choose, oh, I don't know. I guess the 235s would be good. So we'll sell the 235s here. Okay. And now you got a payoff that looks a little bit like this. And then we can go up and down 2 standard deviations. It'll look like that. Or I can do a combined chart. It's going to look a bit like this. Now take a look at what we got. All right. So you have now an upside call spread. And it's less than 40% of the distance between the strikes. And frankly, if I even stretch this out a little bit more, so let's get rid of these 235s, let's say. I'll delete that. And maybe we can go out to, say, we can go 237, 244, like this. So now we're up to $4 debit on a $15 spread. So we're closing in on like almost a 3-to-1 payoff on a call spread. So one way to take advantage of the skew, if all you're doing is trading NVIDIA options, is say, well, look, number one, it's implying a smaller move than it has historically done. And secondly, a call spread pays me a better risk-reward relationship than it historically would have, because the out-of-the-money call is trading at a higher implied volatility relative to the call I'm buying than would normally be the case. You can also even clean this up still further by probably just trading something that is very simply in the money. So let's do this now. Let's take a look at trading something like that. Okay. So now we are looking, is that pretty close? Let me just make sure. So 215.934. Now take a look at what we have. Okay. So now I have an in the money call spread. Stock's trading almost 223, almost $8 in the money. So I'm paying about $1.50 worth of extrinsic premium, $9 worth of downside, and upside from, call it, 224 to 240. So that's significantly more upside. So asymmetric risk reward, isn't that what we kind of hope we get out of options, right? So even without taking a look at what index options prices are doing, you can take advantage of the skew to make a bullish bet here with an asymmetric risk reward. This is not something you typically would get in a single stock equity option. And certainly it's not something that you would get in an index option. What's the other thing you could do? You could trade a risk reversal in the Qs or SPY to make a bullish bet. Similar dynamic, but here what we're trying to do is not buy the lower strike and sell the higher one because of the skew, but actually sell the lower strike and buy the upper one. So let's take a look at that. We'll do that in Qs, and I'll show you what I mean. So here what we're going to do, same expiration, still trying to capitalize on the skew dynamics. This is, you're making a couple of bets here, right? When you do this in the Qs. Why is that not populating? Refresh this thing. There's Apple. So one of the things you're doing if you traded this using the Qs is you're betting that the Qs are going to behave kind of like NVIDIA will or should. NVIDIA will have a profound impact on the value of Qs, but that does not necessarily mean that they can't see divergence in price. In fact, the options market is actually suggesting some degree of divergence. So how would we do this? So this is the dailies. I don't care about those. We're just going to go out to the end of the week again. So one thing you could do in this instance, so we've got it at 704, is sell a downside put and buy an upside call for about even money. Now here the implied move by the end of the week is going to be much smaller, right? It's going to be more like 2%. So a 2% out of the money call, and maybe you don't even want that, but we'll just say 2% on 704 spot 30. That's 718s, let's call it. Let's just choose the 718 calls. Let's see what we can do here. So if we buy the 718 calls and we pay $2, what put do we have to sell to do that for even? Well, it's going to be either the 689s or maybe the 688s, like this. Okay. All right. So what do we have now? Once again, we have pretty much an even money trade. Okay. Now you get something that looks a little bit like this. I want to go up and down 3 standard deviations. I think that's probably more helpful, right? So you basically have no exposure in this area to speak of. But one of the things you're going to notice is that you get some upside participation a little bit sooner than you take downside participation, right? So again, slight asymmetry in this relationship would be, one of the ways to do it. And something else you could potentially do, although it's not as sexy, simply because the call skew is a little bit lower, is you could do a call spread risk reversal, buying an upside call spread to bring this in a little bit. But that's one of the other things you can do, right? So in this case, like I said, the stock is trading 714 versus 688. So, not 714, sorry, 704 versus 688. So it's $16 out of the money this way and $14 out of the money that way. Or you could do some combination of these, depending on how clever and creative you choose to be. Alex V, looks like traders expect NVIDIA to go lower. So, I don't know if, we can look at what the options are pricing, and then the next question is what might motivate it? What could they be looking at? What could they be seeing? Why would there be a call skew? One possibility is that there's a lot of equity exposure. People said, I'm going to take some profits here, but they have a FOMO issue going on, right? So you've owned NVIDIA a long time, and you're thinking, this rally has gotten long in the tooth. I'm going to take some profits here. And then you do that, and you think, but what if they have another stellar quarter? What am I going to do? So you buy some calls. And you don't mind buying those calls because the implied move is slightly less than it has been historically. That would be a possibility. But the skew is not overtly bearish, right? It's not deeply negatively skewed, which would suggest it. But the flow is bearish. So this is the reason I'm bringing all this up, is that there are a lot of things you want to take a look at when you're trying to gauge option sentiment. One is the initiating flow. Call buyers versus call sellers, put buyers versus put sellers. The other is the volatility surface, and the other is the volatility surface for a given stock relative to its own history and relative to indices or ETFs, basically baskets of which it might be a constituent. And I kind of thought that one was sort of interesting here. So Monday morning quarterback, I don't know if that helps you in terms of what you were thinking. You could do a similar trade to any of these in SPY, by the way. And the other thing is that because of this dynamic, if you are going to, if you have long stock and you want to use a collar, that collar, a zero cost collars, is going to stack up pretty favorably. Let me pull that up so we can see how that looks. Bear in mind, if we start talking about zero cost collars, that why do people put collars on? To hedge their positions. I just want to offer this, not a tax lawyer, not an accountant, not providing you any tax advice. You do need to be aware, though, that if you have a position in NVIDIA and you're not an institution or a fund where you just basically have some aggregated P&L, you do need to be cognizant that sometimes trades of this sort, like putting a collar on a long stock, can have a tax implication even if you don't do anything with your shares. So it can do things like adjust your basis or your holding period, right? Typically is the way that happens. So you may not necessarily realize a gain or a loss, but if you, my understanding is that if you collar up a long equity position, you can essentially reset the holding period. And that may or may not be worth it, depending on your circumstances. If you're already in a short-term gain, so for example, let's just say you bought the stock over here, you haven't even held it. Well, actually, that is about a year. So that would be a long-term gain. Let's push it out to here. So you're actually not in a long-term gain area yet. If you reset the clock, maybe that matters to you, maybe it doesn't. But if you're over here and it is a long-term gain, so you've got basically a clean double working right now. So you're up 100%. Is trying to collar up a move here going to really help you, given the potential tax implications depending on your jurisdiction? Maybe, maybe not. But leaving that aside, why don't we just take a look at what a collar looks like given the skew dynamics that we're talking about. So we're going to assume that, one, you're long the stock. So we're going to look at this. So now you have that situation, right? So that's what your P&L looks like if you're long the stock. You want to give yourself some downside protection. So you go and find a cheap put to buy. And let's just say, for the sake of argument, that you're saying, okay, well, I'm willing to pay 1%. 1% probably gets me into these 210s right here. So I'm going to buy those. And then I want to do this at zero cost. So I need to find a call to sell at about $2. I'm going to do that. And here we go. So this is going to look a lot like that in the money call spread because synthetically this is functionally equivalent. Long put, long stock, synthetically a long call. In this case, I'm long the 210 call synthetically against the 240s, but I still get this asymmetric risk reward. Now, if you have no position and you kind of want to own the stock after, and the in the money call spread thing is a little bit confusing, this is the functional equivalent. So you could do this just as well and get an asymmetric upside to downside. So, all right. Oh, we have another one here. So let me see here. Okay, Monday morning quiet. You have a big collar on. Good. Yeah. So, good news. Maybe you noticed this. Maybe you weren't looking at. Maybe you were looking at skew. Maybe you were just looking at the prices and said, "Hey, I could buy an out of the money put that's not as far out of the money as a call of the same expiration that will finance it completely." So, if we are expecting a 7% move on NVIDIA, what about base on that percentage range, do a credit put spread for 3 days to expiration like a 205-200 for about $1 credit, just an idea. Yeah, so that's fine. Well, let's take a look at that. So how would I mean, there's two things to think about when we look at this. The first is, what do you believe is going to happen right now versus what has happened in the past, and how would a trade like that have stacked up using what happened in the past as our guide? So for that, I'm going to create a custom range that begins a day prior, because they report after the close, to 2 days after. Okay, so now we've got all of our moves. And we're going to just drop all this into Excel. If you did a 205-200 versus 222.5, so that means you're selling a 92 moneyness, 92.1 moneyness trade. So let's just we'll just do a quick, we'll just basically back test that, right? So, so that's the current price, and you're looking at selling the 205s and the 200s. So really what I'm interested in is, so this is now equal to that divided by that minus that, and this is equal to that divided by that minus 1. So this is the money, how far out of the money those respective puts are. And so each of these puts is now going to be worth, this is now going to be worth equals the max of 0 or that strike minus the result. Okay. And this one is going to be equal to the max of 0 or P3 minus the result. And that spread is going to be equal to this minus that. So now we can get some basis for what that spread is typically worth. And it looks like that has that really worked out that often? Wow. The average value for that put spread is just 12 basis points of the common over the last 11 years. And you're collecting, you said $1. So this is going to be 44 basis points, almost 45. Yeah. So SFL Trades, history likes your trade, it turns out. So that's I guess, pretty good news. That's a good way to look at it. And what I like about this is that normally selling those put spreads, not that attractive, except when the skew gets this way. So you don't have put skew. The lower strike puts are actually trading at a discount to the higher strike ones. So you're looking at a 7% plus. This is actually 8% out of the money. You're looking at an 8% out of the money put. Basically 8-10 put spread. And you're getting 20% of the distance between the strikes. Normally, I'm not crazy about that, but that looks pretty good. And for that, there is something else we can take a look at here. Let's see what we get. What we get. Come on. Let's see if one of those things came up here and see what this looks like. So this one's looking for call credit spread, put credit spread. This one's going out a little bit further in time. Do we have any short-dated put credit spreads in here? Not quite that short, but this one's fairly similar. It's just a week further out. So the May 29th weekly, so going out another week, 207.5, 202.5, also a $5 put spread, getting a little bit more money out of it. So this, by the way, is based on the platform that Dom, had he been joining us, would, this is the system that he uses, that I have access to. You guys will also be able to, I think this is now available for you publicly if you go to, let's just try it, because I have access to it. Let's do this, Phospho Trade. Oh, looks like it. So that is now live for customers in the United States. But yeah, this is going to show trades as well that have high probability of profit, and will calculate how much the expected P&L, the maximum risk that you're taking, the target prices, things like that. There's a lot more analytics and so on that we had hoped Dom would be displaying for us. And he will surely walk us through all of this cool stuff when he does join us, hopefully in a week. But yeah, so to answer your question, let's see here. Jim Howard, is there anything in medical devices starting to emerge as interesting bottoming to you in the healthcare index? You're looking at Intuitive Surgical, Abbott. Let's see. Did I share that, by the way? Let's do this. So you're looking at the healthcare index. Just to be clear, when you say that, you're looking at something like XLV, the healthcare select sector. This is the ETF that has it. I'm pulling this up because I'm not sure of my IXV. So Lilly, that will leave the pharmas out of there, but you're mostly interested in medical devices. Well, let's take a look at Intuitive Surgical. Let's see what that looks like. Technically not great. I do like healthcare in general. Yeah, so that one's not great, but let's see what we have here. Full disclosure, my wife actually works for a medical device company, but it's not publicly traded. So the Holly Index is not really going to help us in this particular case. I think it's owned by a private equity company. I'm not 100% sure. But XLV in general is a mixed bag technically, but the two best indicators, at least over the last year, are positive on it. You know what? Let's do this, Jim, if it's all right with you. Oh, you're looking at the IHI ETF. Let's do this. Rather than having me speculate live, because we are going to be doing open mic tomorrow. So Stryker, incidentally, third one down on the list, is a company that my wife's company competes with. Her view, and mine too, based on what she tells me, but again, not totally agnostic on this, is that the products they sell are superior. Better products, lower price than Stryker. But the Stryker people, I will tell you, I've heard good things about their sales staff, so they're making good moves in that sense. Let me do this, Jim, if it's all right with you. Also, because we only have, we're chewed up almost an hour here anyhow. Let me take a look at this, if that's all right. And we can revert after the close on open mic after I've had the opportunity to do a little bit more homework on these stocks, which is what I intend to do. Again, so for all of you who decided to tune in either live or are watching a recorded version of this later, greatly appreciate your patience today, because we'd anticipated doing something completely different than this. But live streams, live television, live video, live whatever, being what it is, you have to roll with whatever circumstances give you. And in this particular case, it did not give us Dom, but hopefully he will join us in a future one. But for those of you who joined this one, I'm glad that you did. Be sure to like, subscribe, hit the notification bell, leave us your comments, and join us tomorrow, 4:15 Eastern Time, when we have open mic. And one of the things we're going to be talking about is medical devices. Thank you all very much for watching. See you soon.